Welcome to today's deep dive into Bittensor subnet valuation. If you've been following the crypto AI space, you've probably heard about Bittensor's dynamic TAO upgrade in early 2025, which gave every subnet its own token and fundamentally changed how we should think about valuing these assets. Today, I want to show you why the market is systematically mispricing subnet tokens and why this could be one of the most asymmetric opportunities in crypto right now. Let's start with the tokenomics comparison that everyone's missing. Most investors are still applying last cycle's playbook to subnet tokens, but here's the thing: subnet tokens are structurally different from anything we've seen before. Think about Bitcoin for a moment. Bitcoin launched with no pre-mine, no insider allocations, and follows a predictable, transparent emission schedule. Subnet tokens work exactly the same way. They launch directly into public markets with zero insider preferential pricing. Risk, upside, and emissions are distributed from day one. They follow a Bitcoin-like emissions curve, front-loaded initially, then tapering over time. Now here's where it gets interesting. Subnet token emissions run roughly twice as fast as Bitcoin, which means their circulating supply trajectory is predictable and much faster than Bitcoin's decades-long schedule. By month 6, approximately 11% of total supply is circulating. That's about 2.5 million tokens. By month 12, we're looking at 25% or 5 million tokens. And by month 24, we reach 50% of total supply, around 10.5 million tokens. But here's the kicker: full subnet token supply won't be reached for nearly 65 years, just like Bitcoin. So why are investors using fully diluted valuation to price assets that won't reach full dilution for over 6 decades? This brings us to the valuation methods that actually make sense for subnet tokens. The crypto industry got obsessed with FDV during the last cycle because of low-float, high FDV tokens with massive insider allocations. But subnet tokens broke that mold entirely. For most investors operating on a 6 to 24-month horizon, FDV projections decades into the future are largely irrelevant. Nobody uses FDV to value Bitcoin, and we shouldn't use it for subnet tokens either. Instead, a more practical approach applies a 0.5 multiplier to FDV based on projected circulating supply over a 24-month investment horizon. When you evaluate subnet tokens through this lens, they're trading at roughly 50% cheaper than what the FDV implies. That's already a significant discount, but we're just getting started. Now let's talk about the impact of staking APY on valuation, because this is where the math gets really compelling. Subnet tokens currently offer staking rewards exceeding 90% APY. For long-term holders, this materially lowers the effective cost basis. Think about it this way: a 90% APY over 1 year nearly doubles your position, effectively cutting your entry price in half. Over 2 years, even as yields decline, you're still looking at approximately 120% total return from staking alone. So let's combine these factors. If you're buying a subnet token that's effectively trading at 0.5 times FDV based on 24-month circulating supply, and you're earning 90% APY through staking, your realized valuation falls closer to 0.25 times FDV. The staking yield doesn't just compound your returns, it compounds the mispricing. Here's the bottom line on current valuations. With a 1-year hold, adjusting for subnet token staking yield and circulating supply, investors are effectively buying at approximately an 85% discount to FDV. With a 2-year hold, that discount approaches 75%. But there's more to this story. The market has been absorbing emissions under particularly unfavorable conditions. Miners earn 41% of emissions and typically convert portions to cover operational costs. Additionally, the root network's design created automatic selling pressure by routing validator emissions into TAO to fund passive stackers. However, this dynamic is rapidly unwinding. Validator emissions to root follow an exponentially declining curve, meaning more emissions now flow directly to subnet token holders who are less likely to sell. This structural shift is setting up what the community calls subnet summer. From my perspective, we're at an inflection point. Established crypto AI teams are developing subnets, institutional funds are exploring allocations, and retail participants are responding positively to the absence of pre-mines and insider allocations. Even Bitcoin maximalists are accepting TAO as the decentralized AI play. The infrastructure is improving, incentives are aligning, and momentum is building across the ecosystem. Subnet outputs and services are meaningfully improving across verticals, while new concepts continue pushing the boundaries of what's possible. My opinion on current subnet token values? We're looking at systematic undervaluation driven by the application of outdated frameworks to a fundamentally new asset class. The combination of transparent tokenomics, high staking yields, predictable emission schedules, and improving fundamentals creates a compelling risk-adjusted opportunity. The conditions are in place for a breakout phase that could significantly revalue the most competitive subnets as capital, usage, and attention accelerate. For those who understand these new valuation dynamics, the opportunity window may be closing faster than most realize. The market is still pricing subnet tokens with yesterday's playbook, but the smart money is starting to catch on. The question isn't whether subnet tokens will re-rate. It's whether you'll position yourself before the market catches up to the math.